What influences exchange rates? Hello everyone, I'm Amy. I'm happy to welcome you to my channel Amy Forex and to the lesson 11 of the 24-lesson course. I'm a professional trader with over 5 years of experience and annual income of $1 million. Trading has allowed me to move to Dubai and live the life of my dreams. I'm also the founder of a successful forex trading robot. Based on my professional experience, I've created and recorded 24 lessons. These lessons will turn an absolute beginner into a professional trader. The first 12 lessons are the basics that anyone who wants to start making money in forex needs to know. You can watch them for free on my YouTube channel. The second part of the course is for those who are in need of more in-depth professional knowledge. It's for those who dream of making trading their main source of income, but don't yet understand how. The second part of the course is the real toolbox, the secret sauce of every professional trader. It is in the second part that there is a unique information and detailed explanations of complex strategies that will lead you to a wealthy life. Study each lesson carefully and follow the link in the description and click Start to access the second part of the course, the secret sauce. Do one simple thing and I'll send you the secret sauce lessons. This is life-changing information. After my course, you will be earning sums that you could never have dreamed of before. And now is the time for learning. Before we look at the factors and players that influence the exchange rates, we must understand how these rates affect economies. First of all, exchange rates influence the trading relationship between countries, which is a major concern for central banks. Let's look at the Euro-British pound currency pair. If the British pound increases in value against the euro, it makes British exports more expensive for European buyers. Countries are constantly trying to sustain a healthy currency exchange rate in order to help their exporters. It's a very challenging task because a low currency rate can be good for exporters, but it's usually not so good for businesses that import goods because those goods will become more expensive for them. Central banks are in a constant struggle to achieve and maintain an exchange rate that would be good for all participants of their economy. The golden rule of economic data reports. Forex traders closely follow economic calendars. Forecasts and reports about such data as inflation numbers, unemployment rate, GDP, etc. can significantly influence currency prices. Markets don't wait for the actual reports to come out. They start reacting and moving based on expectations and forecasts alone. Let's talk about 9 key indicators that drive exchange rates. Interest rates. Interest rates are set by the reserve banks and act as benchmarks for financial institutions. A higher interest rate means that borrowing money is more expensive long-term because the interest you pay back to the borrower is higher, and it also makes saving more attractive because you can yield a higher interest in your account. Under this logic, a lower interest rate is indicative of any unhealthy economy because the central bank is trying to encourage people to spend more money to stimulate the economy. The same is true of the opposite, and it's in this way that interest rates play a huge part in controlling the economy. Therefore, a country with the highest interest rates attracts more foreign investment, and its currency rate drives up. If the economy is in a downturn and companies are nervous about the future and are reducing investments, a central bank can lower the overnight rate that it charges smaller banks for borrowing money. Cutting interest rates. What happens when interest rates are being cut? You can see it on your screens. Interest rates below zero. Would you want to be charged for simply holding your money in the bank? Absurd as it sounds, this is what happens when countries want to boost their economies. A negative interest rate policy is implemented as a way to try to boost economic growth and inflation. The idea behind a negative interest rate is that by charging banks to hold reserves, the central bank would encourage them to lend more money to businesses and consumers instead, which would in turn stimulate spending and investment, raising interest rates. It obviously has the opposite effects of cutting them, so we will not go through all the same points. When the markets are expecting an interest rate increase in the US, the US dollar tends to rise in value against other currencies which have lower interest rate forecasts. The exception to this rule is when a country increases the interest rate to save a falling currency. Who controls interest rates? The interest rates are controlled by the central banks. Here are 8 most influential central banks. Look for the small cues. To be ahead of the curve, many traders often look for small cues in wording and body language of the FED chairman's speeches. Even the smallest hint of a rate hike or drop can move the market significantly. Inflation. Inflation is sometimes called the pulse of the economy. Do you remember how much you paid for bread or milk when you were a child? Most probably at least twice as little according to statistics. Of course, the prices have risen even more during the inflation boom of 2022. But anyway, as you can see, there are things that have become less expensive like TVs and other electronics. Here's the deal, if you can keep your money in a sock under the mattress, a year from now, your cash will buy you fewer goods than today. This increase in the general level of prices is called inflation. Inflation is measured as an annual percentage increase in prices for a defined set of goods and services. Growing wages. When inflation is a bad thing, here are the cons of the unexpected inflation. Deflation. Deflation is the opposite of inflation. Deflation means that the general level of prices is decreasing. Falling prices sound awesome, right? Not if they last for a long time. A single month of deflation is not bad, but if deflation is prolonged, it comes with a strange deflationary psychology. Consumers and companies stop spending money as they hope that the items they want to buy will soon become even cheaper. GDP Growth Rate. The GDP represents the value of all finished products and services produced by a country, usually on an annual basis. The forex market usually looks at the percentage change in the GDP on a quarter-to-quarter basis. If the annual increase in the GDP is at 3%-3.5%, it indicates a healthy economy. If the rate is higher, it can be a signal that excessive inflation is forming. If the GDP growth is negative for 6 months, it is considered a sign of a recession. Employment statistics. Changes in the unemployment rate can have a sharp effect on the currency rates, especially if the results differ substantially from the numbers the analysts were expecting. Trade balance. The trade balance is the difference between the exported and imported goods and services during the reported period. Political events. Political events can have dramatic effects on currency rates. The most significant political events are elections, referendums, and different scandals. Elections. Elections usually create uncertainty about the future of a country. When the leaders of a country change, it often comes with a different approach to fiscals, taxes and government spending, and monetary, interest rates, bank reserve settings, policy, both of which have a direct impact on currency rates. Referendums. Lately, referendums have become quite popular, creating opportunities for currency traders to profit from them. Scandals. When a corruption scandal erupts at the government level, it can impact the economy of the country either by sparking protests, work stoppages, or even triggering unexpected elections. Military conflicts. Just the threat of a potential military conflict tends to destabilize the currencies of the involved nations. Quantitative easing. When a central bank performs QE, it's essentially printing money. Nowadays, it is mostly digital, to purchase high quantities of bonds from smaller banks. Here are some tips on how to use fundamental analysis in the currency exchange market. Use an economic calendar. Check the key indicators. Analyze forecasts. This is the end of lesson 11. Don't forget to subscribe to the channel so you don't miss any important information, because the next lessons are waiting for you. Also, be sure to follow the link in the description and start trading with the robot. Like this video, and I'm looking forward to seeing you again.